Hey, how's it going? My name is Christian with Plan Your Federal Retirement, back with another video with our All About FERS series. Today, I'm going to be talking about annuities. And if you've ever wondered why here at Plan Your Federal Retirement, we're always cautious when we talk about annuities, then this video might be the right one for you. So OPM refers to federal employees who retire under the federal government and collect a pension as annuitants. They refer to that pension as an annuity, and you, the retiree, as an annuitant who receives that annuity. The only problem with this is that, generally speaking, annuities are purchased from an insurance company where you buy an insurance product, the annuity, you give them a lump sum or a portion of your money over a certain period of time, known as a premium. And in return, that insurance company promises to pay you either immediate income or deferred income for the future, for the rest of your life, or for a certain number of years, or for yours and your spouse's life. Whereas a pension is specifically offered from an employer to an employee as part of a retirement program where that person who's retiring is going to receive that monthly income for the rest of their life. Again, it's exclusively offered from an employer. So that's the big difference, right? If an OPM is referring to it as an annuity, which is purchased from an insurance company, it's really just a pension because it's offered from an employer to the employee who is retiring. And that's not just the only reason why we call it a pension, but we also call it a pension so as to not get it confused with the TSP annuity option. The TSP annuity option says that you get to either give all of your money or some of your money to the TSP annuity vendor, who is MetLife Insurance Company. And in return, MetLife Insurance Company gives you an annuity. And this is an irrevocable decision that you could make. And anytime we hear that word, we always want to push the pause button, right? It always should raise our red flags to say, is this the right choice for our financial plan, something that's irrevocable, or do we need to look at this a little bit further? And I can't tell you anytime I've ever recommended the TSP annuity option or here at Plan Your Federal Retirement has ever recommended it to a client when we have a lot more options outside of the MetLife annuity options that we have offered through the TSP. I'm not ragging on annuities. Annuities could be a good tool in someone's financial plan, and we've recommended them before. It's just that when it comes to this TSP option, and it's irrevocable, that's where we're going to be very cautious. So that's again why we're very particular when we're talking about the FERS pension. Again, we don't want to confuse that with the TSP annuity option and someone goes and makes an irreversible decision that they can't, again, reverse. So this actually comes directly from the TSP annuity fact sheet. And it says, once the funds for your annuity have been dispersed, you cannot cancel the annuity, change the annuity option, or change the joint annuitant. It further says that on the date when the annuity provider receives your request and the money from your TSP account, generally within 2 business days after the money is dispersed, the annuity is purchased. Okay, great. So you fill out the application, you decided that you wanted to purchase an annuity. 5 business days later, that money from the TSP goes to MetLife. And then 2 business days later, they've now considered that annuity purchased and you can no longer cancel it. So any annuity company outside of MetLife in this case is subject to something called a free look period. And it's a 10-day free look period that every company in the United States is subject to be held to, and in every state. Some states in particular have even a longer than 10-year free look period. So what is the free look period? After you fill out an annuity application and that money is transferred to the annuity company, they're going to send you a contract. Once you receive that contract, 10-day free look period says now you have 10 days from receipt of that contract to decide whether you want this annuity product or not. And if you don't want it, you could cancel it within that 10-day free look period, and all of the money would come back to you, no questions asked. You could move forward, you could walk away from the policy and not keep it. And that was adopted into law because there was a lot of people who regretted their decision on making an irreversible decision to give their money to an insurance company. And so because we don't have that inside the TSP annuity option, that's why, again, we're very hesitant of it. Additionally, with annuities, there's also something called a surrender charge period. And the surrender charge period, depending on the insurance company, depending on the product that you get, you can change how long or how short your surrender charge period is. Let's just say it's 10 years. And let's say you gave $100,000 to an annuity company. The surrender charge period would say if you wanted to cancel your policy in the first year, let's say, you would just be subject to that surrender charge. And that percentage can vary, can be different for each insurance product, each insurance company. But let's just say you put $100,000 over, and in the first year you wanted to cancel your policy, there might be a 10% penalty surrender charge. So you get $90,000 back. And then, for example, in the next year, you decided to cancel your policy, there'd be a 9% surrender charge. So you'd get $91,000 back. It's kind of how those surrender charges work. And you can change how long that you want that surrender charge period to last. It's dependent on the insurance company and the insurance product. So going back to the TSP annuity option, we already know that we can't change our mind when we buy it, but we also aren't subject to that surrender charge period. We can't cancel it in the future, even with the surrender charge, and get our money back out of it. Again, something that we just don't see outside of the TSP option. While we're on the subject of annuities, it probably makes sense to talk about them just a little bit further. There's lots of different structures with them. We could give our money to an insurance company in the form of a lump sum, or we can give it in the form of monthly or annual premium payments. At that point, we can decide whether we want that income from the annuity immediately or if we want to defer it to later years. So you can give your money to an insurance company, and for 10 years, 12 years later, that's when you decided that you wanted to turn on the annuity, and then they would give you money for the rest of your life and or your spouse's life. Along those same lines, you can choose single life annuities. You could choose joint life annuities for you and your spouse. You can choose it for a number of years for which you're going to receive that money. Oftentimes, annuities have other riders, like income riders, that you don't actually have to annuitize the product. You can take out withdrawals or income from it. There's also sometimes some long-term care riders that you can add to it, and other special riders that you can add in addition to the policy, which makes it kind of nice. The other important thing to be thinking about with annuities would be if we're going to do a fixed annuity, a variable annuity, or an indexed annuity. A fixed annuity isn't considered invested. That money that you put to the insurance company goes to that insurance company's general fund. They invest the money, but they're guaranteeing a fixed percentage rate for your annuity that it will grow by. And there's a guaranteed rate and there's a non-guaranteed rate, but technically it's not invested in the stock market. Whereas a variable annuity would be variable, that you can invest that money in index funds, mutual funds, and you can choose however much you want in stocks or bonds. And as the market goes up and down, so does the value of your variable annuity. And then lastly is the indexed annuity. And indexed annuities are a lot more complex, kind of blending both a fixed and a variable product, but they can make a lot of sense for some people. So hopefully you found this video helpful as we talked a little bit about OPM's version of an annuity versus a pension, as well as the TSP annuity option versus other annuity options that we have outside of the TSP annuity. If you have questions related to annuities, feel free to leave your question below in the comment section. Make sure you are subscribed to our YouTube channel so you get our latest videos and content that we put out. And until next time, happy planning.